Hello, Maverick traders. Welcome out to your market roundup, July 29th. Corey here with you. Let's jump in. We're always going to take a look at meaningful news, and sector rotations are critical. You've certainly seen that in the markets of late. The average everyday stock, the kind of Russell 2000 type of name, doing just fine. The large cap tech, which is a big component of the S&P, but the large cap tech really struggling. So we want to watch those changes in the marketplace, and then that will lead us to the very best upside, downside, or neutral trade ideas.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's break down what happened today.
So today was still just one of those more quiet days that we've been seeing of late. Dow, S&P, NASDAQ, nothing happening, literally flat. But the Russell gave back some ground, down about 1%. Oil has struggled of late, down 1.2. Gold flat. This oil downturn is really something. If you look at a big chart of light sweet crude or something like that, it's in an ascending triangle, but we've moved down to the low end of the range. So where oil goes, so goes the energy components. You'd have to give it a little bit of the benefit of the doubt in terms of when it gets to the bottom end of the range, but until that time, and while it's in this down phase, we've been highlighting bearish trades on the energy sector. All eyes this week are on the Fed meeting. The Fed meeting is on Wednesday. Market participants are watching that closely. Generally speaking, if you look at the times, there really in the last couple of decades, there's been two rate cutting cycles. There was one back that started in 2007, and we know how that ended. Of course, we went through 08, 09, and the global financial crisis. There was another rate cutting cycle back in 2019. And then, of course, COVID hit, which kind of threw everything into a curveball. This is going to be the third that we've seen in the past couple of decades. When you start to cut rates, when a central bank does, it's not like it's one and done. This rate cut will be followed by another at some point and another one behind that. And historically speaking, rate cutting cycles are not a time that's bullish for stocks. Think about it. Why is the Fed cutting rates? What has happened? Why is the economy slowing? These are the cycles that things go through. So actually, stock returns are better while the Fed is raising rates. They're worse when the Fed is cutting rates because it kind of tells you that that cycle, that bullish cycle of the economy and the stock market and all of that has overheated. Inflation's become a concern, and now they have to fight some demons. And generally speaking, stocks really struggle while you're in the midst of that rate cutting cycle. Advanced decline line, about 56% of stocks down, 40% up on the day, so a little bit more selling than buying. 50 period moving average, still slightly bullish. This is one good thing that we've seen, is that although the S&P and the NASDAQ are now struggling, it's those key names that are pulling it down. The average stock is doing okay. Now, as we look at this S&P chart, let's make sense of it. So I had been negative on the markets. We talked about this gap and how we watch gaps as being an indicator of things to come. Just like this, if you look at some of these gaps, like here's a nice breakaway gap to the upside and follow through higher. Here's a breakaway gap to the downside and follow through lower. But that gap has really played out. We can't keep looking back at that gap and go, well, it has to keep selling off because it had a gap back there. Now we've got to figure out where we go from here. This kind of foretold or signaled that there was probably some selling, some supply that was going to come in. This is a trapped bull situation, and the selling pressure, the supply certainly came in. But where do we go from here? The S&P pierced the 50-day, and now we've bounced back above it. If you look at the QQQ, well, here's the Russell. The Russell is actually quite strong, but bearish engulfing candle today, which is again, generally speaking, not a great candlestick, suggests that there can be a little bit more selling. Maybe we come back to the bottom end of this range in the Russell. If we look at the NASDAQ, there's more damage done. Same thing where it had the gap, which suggested, pointed towards more selling coming. Now that has played out. We certainly saw that. So where do we go? I think this NASDAQ chart is key because really it's the big drivers of the market. We know how important the big seven is. Apple, Google, Amazon, and so forth. They move the market. They're a big component. So you could have 100 S&P stocks go up. If those seven names go down, the S&P is going down, right? And so that weighting, that discrepancy, if we're just looking from an index level, I would still anticipate we're not done to the downside. However, a little bit of positive news. Generally speaking, when you go into these cycles, if we were to make a drawing of this, here would be my general drawing. You have an uptrend, higher highs and higher lows. You break down in the short term, lower highs, lower lows, kind of a little zigzag lower. And we can see that. See these peaks and valleys, and now you've kind of gone down and you have these little zigzags lower, right? Similar to my drawing. Look at the moving averages underneath. When you're in an uptrend, you've got these healthy moving averages underneath. When you move into a downtrend, you start to pierce those, but what happens is really there's usually a kick back up into these moving averages, and they roll over and kind of hold. So that we're in that little phase where generally speaking, you'll get a little bit more upside. You know, if I had to make a guesstimate here in the short term, I'd expect that when they try to sell the market off, it probably shakes it off and then rallies back, and then we get a little bit more upside. I think you're going to come into this type of area in the S&P chart, same type of dynamic. I think there's a little phase of buying. Now, ultimately, whether you're a Fibonacci trader, an Elliott wave trader, what have you, I would suspect that this will just be a retracement. You know, if you were to measure from peak to trough and say, okay, where does it rally to? Maybe it's a 38.2% retracement, one of those fib numbers, right? Right in here. Or maybe it's a 50% retracement, which might be right up about there. But that's really the sweet spot, is kind of right into that zone is what I would anticipate. So in the very short term, do I think there's going to be a few more days of buying? And, you know, maybe the Fed meeting is a catalyst. Maybe it's just supply and demand shifts. But the norm for this is you break the levels, going to have that first flush to the downside. The buyers don't go away easily, and you get a ricochet back into this zone, and then the supply comes in, and it's heavy. And look, we have supply coming in. You can see the selling pressure. My guess is that we'll have kind of a weaker rally on lighter volumes, and then a whole new wave of selling pressure comes in. And look, the news is going to try to put a why behind it. They're going to say, oh, this was the reason it sold off here is because of this economic number or because of this whatever. I think it's just mechanics of the market. I think we're in a shift from a bullish market environment to a more bearish. And when you're in a more bearish environment, you'll get these ricochets back up, these little bullish corrections. But at the end of the day, they're probably selling opportunities. And that's what I would anticipate is going to play out here. Now, if we look at today's reaction here with oil down 1%, no surprise, you see quite a bit of red there in the energy space. Otherwise, a little bit of mixed picture. Certainly very green in Tesla. That helped hold the markets in a little bit more. Apple had some news about their new AI iPhone and so forth. Nvidia, we know how impactful that has been. A little bit of a weaker day, but it's just spread out. I would say a little bit more green in certainly the consumer sector. There's some good green, some communications area, quite green there. Disney had a nice day on the back of some solid movie numbers. Now, if we look at our weekly outlook, this would very much fit with my personal opinion is that there's probably a little bit more upside on the weekly time frame in the very short term, but the monthly has started to give some ground. Do I think we're in this rollover phase overall? I suspect that's exactly what's going to happen, but again, buyers probably don't give up quite that easily. Now, let's highlight some bulls, some bears, some different opportunities. We've got a mixed bag. If you are looking in energy, there are a couple of energy stocks that are interesting. And with oil coming back towards the low end of its range, that could be, an area where it bounces. I would pick the stronger names like Apache. That's a great looking chart in the energy space. We've got a healthcare stock. We've got a couple of financial stocks. On the bearish side, we also have an energy name. We've got an airline. We've got a healthcare. We've got a consumer stock there with Royal Caribbean. So let's look at a few of these charts. Here's HIG, which is in the financial space, has broken out of a multi-month base. That is strong, good bullish breakout. I don't think you have to chase it here. You'll probably get little pullback, little consolidation, something. But ultimately, that's a chart that's probably going to go higher, not lower. Next chart, MetLife. Here again, this is in the energy patch. You can see the breakout, and now it's consolidating. And probably another breakout could emerge here. For this one, if you wanted to jump on something immediately, HIG has more of that momentum. If you wanted to play something for the next phase, if MET breaks out above this range, you could play it for a little bull call spread, something like that. If you're looking at the risk graph, positive, negative, break even. If you play a bull call spread, you could build something where you're risking one to make two, risking one to make $1.50, something like that, and maybe target a move up there towards about $80 per share. Here we have Delta Airlines, more bearish, certainly downward trending, 20 below the 50, both downward sloping, lower highs, lower lows, recently basing, and you can see the little rollover today. This is comparable to a little mini inverse cup and handle, or just descending triangle is basically what you have in place. Bigger bounces followed by smaller bounces until you roll off the table and break lower. This one looks like it's going to head down there into the $40 range. So Delta Airlines DAL, not a great looking chart for upside, but great looking for bearish traders. And then finally, here's Merck. Merck is still stuck in the range, and you could say, well, might be a sideways candidate until we get out of that. But if I look at the range here, if it maintains below this moving average, and that's a big if, that's a big question mark. But if it fails against this moving average, imagine a red candle, maybe a bearish harami here tomorrow, and then it pivots over again. If we start to get that downward push right here in the next couple of days, you can play it not only back to the support. I suspect the next time down to 123 is likely to break. So you probably play this from about 125 per share all the way down to 120 per share for a short-term trader. If you had a little bit longer time horizon, you could probably play it even lower than that, maybe down to 115 or so. But ultimately, not great price action. Now, what if it just breaks higher tomorrow, up above these moving averages? Then all bets are off, and I would look for something else. Watch for a short-lived correction on the upside in stocks. That's pretty normal. We've broken down. That's that first wave of selling. And then you get a little sense of relief and some optimism, and then ultimately a whole new wave probably going to come in and hit stocks once again. The regular stock, if you're looking for things to trade to the upside, look a little outside the box. Look at sectors that had been left for dead: financial sector, industrial sector, some of these other areas of the market. All eyes on the Fed meeting. We came in this year suggesting that the Fed was not going to cut rates 4 times, 5 times, 6 times like the Fed's own guidance or Goldman Sachs's guidance and so forth. And certainly they have not. But are we entering that rate cutting cycle now? Yes, we are. Will there be one, maybe two cuts this year? Absolutely. One is coming, whether it's this week or in September. They are very likely to cut rates right here pre-election. And then if they were going to sneak another one in, my guess would be that it would be more at that December type of time frame, maybe post-election rate cut. But when you enter a rate cutting cycle, that's generally speaking a pretty bad environment for stocks. If you look at historical return, it's not as good as actually when they're hiking rates. Tomorrow we've got AMD reporting, BP, Procter & Gamble, Merck. Now this one was on the list, so earnings are going to drive that make or break area, and then Microsoft. So stay tuned, plenty of companies reporting that could be interesting this week. Hope you enjoyed today's market roundup. Have a great week, everyone. We'll see you next time.